Alright, let's see if we are live here, and then we'll go ahead and get started. Let me just see if I have confirmation that we're live. And I believe we are, so let's go ahead and just take a look at this market. I'm going to assume that we're live and that we are running here. Come on, Kevin, what do we got? Alright, well, I'm just going to go anyway. We're good to go. S&P 500. Obviously, we had a long, tough week. Actually, I thought real choppy, news-driven market. And if you're a risk-averse trader or investor with all this headline risk and gaps up and down, it was a pretty exhausting week. And let's take a look at the 30-minute time frame. We can see that here we have obviously still this pattern. Let me change my trend tool here to a regular one. So. Sorry for the lack of organization here, but let's get this thing going here. So we saw a pattern, like I said, of lower highs and lower lows. Yesterday we saw our first higher low, and today we did see a higher high, but it fell. The rally ran out of steam, that is, right at that declining 5-day moving average. So it's still not very convincing that this market is going to turn. We've got this prior level of support, which has been acting as resistance, and I think 129 is going to be a very important level early next week in particular. So, looking at this daily chart, we're still, we tested that 100-day moving average. The 50 obviously failed miserably, and again shows why you don't stick your bid in at a moving average. Those are just good visual reference points to look for evidence that there is support. So 129 and then up to really 120, 130 is about where you would expect that rally to go if we do get a rally above 129, because we have this prior bigger level of support, which has been important really throughout most of this year, is 130. So I don't think that next week we're going to get a lot of we're not going to get easy resolution to this market. There's still going to be a lot of headline risk, whether it's in Japan or it's in the Middle East, or who knows what else is lurking out there that's going to hurt this market. But we're seeing obviously that the market is not able to or unwilling to bounce in a convincing manner, and right now it's still a market I think that most people shouldn't be attempting to be involved in right now. We want to wait for the dust to settle a little bit better in here. On a closing basis, we closed at a pretty important level, I guess, because it was pretty much these highs the first week of the year that did turn into support as well. So 127.5 area, we break back below really 127, let's just call it 127.20. So I think that these two levels, this is, if we break below that 127.20, I wouldn't be surprised at all to see a test of last week's lows, perhaps even an undercut, and that could set up for maybe the washout that this market kind of needs before it can regain its footing a little bit. But still, we've only come in a little bit if you just back it up to the rally that began in August. And I mean, if you throw Fibonacci on there and say from the August lows to the recent high, we haven't even retraced 38.2% of that move. If we did get a 38.2% retracement, let's see, I didn't even draw that correctly in the same spot, so let me just change the scaling. We're going from this level here. If we were to get a 38% retracement, it would get us down to this level from what was that, late or early November, which was an important level, down near 123. I don't think that that's going to really occur. I think if we get a break of these lows, I think we probably will try to stabilize near 125. But it's gonna have to it's gonna be dependent upon this news still. So the news headlines continue to be scary and ugly, and we see a lot of volatility this morning in oil. If you take a look at West Texas Intermediate here, we had this market. Excuse me. So in the overnight, oil was up pretty strong. So if we take a look at basically what 4 p.m. or 2 p.m. when the oil market closes, the overnight trading, we saw oil rally from about this level here of 101 up to 103.5, and then just as the market, the equities market, was just before the equities market opened, oil really sold off hard. At that same time, that's when the S&P 500 futures took off, and that was the high for the day in there on the S&P 500 futures. And let's just back these S&Ps up. You can see that pre-market, that's where the market got going, and then right at 9:30 Eastern, that rally basically gave itself up, and we were below the volume-weighted average price for almost the entire session here. We had a little blip above. Now the futures did close, and the spiders closed with a little bit of a gain, but again, be aware of what's the direction of that 5-day moving average. It's very important to the intermediate term trend, and until we see that mark, the 5-day moving average flatten out, and then we get above it and hold above it, well then possibly we're going to rally. But again, to where? Where is this market likely to encounter resistance? And I think that 130 area, and you can see it best really on that daily time from the 130 area is a likely level that resistance would be found. We have a declining 10 and 20-day moving average. At 50 days kind of flattened out, and that tells us what? It tells us there's a lot of indecision in this market, and that's the message the market's been broadcasting. We saw the first signs of indecision with these big breaks and the inability of the market to recover, and then we saw the moving averages cross, and then now we see we've got this bigger level of prior support. Will it in fact become resistance? So, that's, you can make those guesses at this point, and people are telling me they called the bottom, and there's no sign, there's no evidence that this is the bottom. I just those are the people that if you're going to tweet me like that, and I'm just going to block you because I really don't care. But anyways, we've got a market that is trying to stabilize. Now, if we get some good news out of Japan this over the weekend, then what's likely going to happen? We'll probably gap higher, and then it's going to be a very difficult trade once again. We had a gap higher on Thursday and today, and then we had markets that were really pretty difficult to trade. You had to be in the right stocks, and that's always the way it is generally anyways, but we didn't get any help from the broader market, basically, is my point, that we didn't have a trending market to help that average stock move. So, still a lot of indecision, and we've got to, keep our eyes on a lot of things, it seems like. On Wednesday, I'd been talking about the yen, and I was looking at the U.S. dollar Japanese yen and calling the yen bearish. Now, this is the U.S. dollar Japanese yen pair, so it's the U.S. dollar that's weak. But anyways, the point is that this, the U.S. dollar in comparison to the paired with the Japanese yen did break that low from 1995, and we've seen just incredible volatility here. Now let me just see if I can change this up and get that to show, and I can't. So I've got just the 9:30 to 4 o'clock in here. Let me see if actually the 2-minute chart. So this is where the intervention occurred in the Japanese yen yesterday, which is just a massive move for a currency. And so far, from the point where that intervention was announced, basically, this market has held about 50% of those of the gains that occurred off that. If you take a look at from a week ago when the Japanese crisis occurred, we basically see that this massive decline has retraced that intervention, got it right up to close to prior support, and also up to the 2/3 retracement level. So that's kind of interesting to look at. We'll see if this market can hold on to some of these gains. That is, the U.S. dollar in comparison to the Japanese yen. But let's go back to equities here. The NASDAQ was obviously weaker today, and there's a line that I guess I had left over, and it's a pretty important level. We can see it was support earlier this year, and it's been resistance. Now, if we take a look at the 5-day moving average in here, and an important level for the NASDAQ next week, I think if we can get above $55.30 or so, then possibly this market could rally up to where, though? I mean, we've got a broken market that has these prior levels of support that will likely encounter where we would likely encounter resistance. So maybe up to 55.80. If it could continue up through there, then the next bigger level will be basically up near about $56.50. But we've got this downtrend line certainly intact. If we can make a higher high next week, then I would be cautiously optimistic. Hopefully it wouldn't occur, like I said, the last 2 days where we had gaps higher. Now in the NASDAQ, those gaps higher, obviously, we've seen weaker action. So, we closed well below the 2-day volume weighted average price since those two gaps higher. So these have been sucking buyers in basically. And unless to make money in the broader indexes, at least, I'm not talking about stocks, but in the broader indexes, in order to be making money right now on the long side, you have to be buying basically at the close and hoping that you're going to get a gap higher to sell into the next day. Well, that's, to me, gambling. There's no odds that favor in there. We are seeing here, which is kind of interesting, resistance at the 100-day moving average, and this is a bigger level that we might in fact test this level down near 54 next week as well. So still just a lot of uncertainty in this market, and it takes time to heal the wounds here and the mistrust. We've had these massive rallies, and things had gotten easy for a while, and now we're back to an environment where it's more most people are putting more caution into the market. It's funny how anytime the market starts to rally, or it says the risk trade is back on, and when it declines, the risk trade is off. It's just kind of a strange way that people are substituting the words rally and decline these days. But it reminds me of that clap on, clap off the clapper, risk on, risk off. That's the market. The Russell 2000 has really held up better than the rest of the markets here. We haven't broken support from earlier in the year. Now I'm getting all confused about I think this was the Egypt lows here. Anyways, then we had all the other crises that we've had, but we've seen that 100-day moving average hold, and this level of support down near $77 a share. So $77 a share, I think, is likely to get hit again. But you look at the 5-day moving average in here, and we've got a little bit different story. We're holding above it, so we gapped above. We didn't continue to rally, but this market held on to the gains. So that's interesting to note that we have a little bit of further, more relative strength in the Russell 2000, and if it can clear these levels, 79.60 basically Monday, then we would expect maybe that it's going to rally up towards about 80.5. So again, there's just a lot of mixed messages from these markets. If we look at the semiconductors, they're still pretty ugly looking. Trying to hold near this 100-day moving average. I think another test of these lows and maybe a slight undercut down to $32 a share would be a good thing for this market, just to kind of get that nice little flush. But still, we just can't trust it. We're seeing rallies fall short of, and in this case come right up to that declining 5-day moving average today. That's where we saw it fail, and breaking back below 32.80 I think would set up that test of this week's lows, and possibly a little bit further flush down towards about the $32 level. The financials, a lot of people were talking about the strength in the financials today, and it was good to see that they did gap above their 5-day moving average and basically held on to their gains in here today. They were up 1.1%, but it's going to take more than that to turn this trend. We got right up to the declining 10-day moving average. The 10 is below the 20, the 20 is below the 50, and we came right up to prior support at $12.35. Today's high was not $12, but $16.35. Today's high was $16.40, and we did hold on a closing basis above that at $16.20. So you could maybe make a case that these are beginning to neutralize a little bit, but there's nothing, 1% rally in the financials is not something to get excited about. Don't listen to the headlines too much here. We've got this bigger level here, 1635, 1640. that the market was unable to get up through. Now, if it can get up above that level and hold above it, then maybe these financials are going to turn a little bit more neutral. But I still think there's a lot of risk in the financials as well. I wouldn't be surprised to see a test of the lows in here as well. We're seeing, for instance, the retail index. We had spoken about this one in a week and a half or so ago. Well, it did break below that support. This is a bigger level in the retailers, and 104, what it was about 104.30. If it can't get above and hold above that level for at least a half hour next week, then it's likely that this market, that the retailers are going to continue to go lower. And I guess some of the talk is that Ralph Lauren and some of these high-end retailers are, I don't know the symbols offhand, are some of the ones that are kind of related to, or there's a lot of business that they do in Japan that. And that's maybe why some of the retailers are getting hurt. Regardless of why, the fact is important support levels have been broken, and for now they're holding as resistance until it can get back above and prove itself. So these markets have to prove themselves right now. There's all the fundamental uncertainty, and it's being reflected in price action. These markets had been basically considered bulletproof. This whole rally, there was a lot of skepticism and a lot of bad news that would get the market down for a day or so, but it continued to rally. Well, now the tune has definitely changed over the last 3 weeks or so with all the Middle East uncertainty, and now obviously Japan and the nuclear concerns over there. So, and in the nuclear concerns, a lot of people have been talking about, well, that's going to be good for the solars, but these solars are basically broken stocks. They are, you look at First Solar, it's not a good rally, a place to rally from. In other words, these stocks, CSEIQ, it's they're broken. JASO, some of the more heavily traded speculative solar stocks. You got STP. I mean, these are not bull markets. They are not turning around. They're not looking like they're ready to turn based on a couple days of strength. It's going to take more than that to turn it. And LDK, I didn't see their earnings, but I saw some tweets that they reported earnings last night. There were great numbers, and you can see the response in there. So all these solars, don't fall for it. It's not going to happen right away, at least. What else did I want to take a look at? We could take a look at some of these. Apple, for instance, closing right on its 100-day moving average, and at this prior level of resistance. That has become support in here. I think that the 200-day moving average is a pretty good distance off, and I don't really foresee that happening here near term. And maybe we get a bounce up to 340, 345 before that happens. But I think that Apple has showing us signs that on the weekly time frame, the pattern of higher highs and higher lows is broken, and now we're going to maybe just begin to drift lower, and this is going to be an important level, this 325 area. Breaking below 325, then I think that Apple's going to be seeing further problems. Another thing, don't fall for this other nonsense. Cisco, for instance. Cisco has been, they report earnings and the stock gaps down 3 quarters in a row. This stock is in a horrible downtrend. You look at the weekly time frame. It's just a bad looking stock. You could make a case, well, maybe it's going to find support in here, but Cisco could be headed back down towards $14 a share. And if it is, then your little 1% dividend that you have to wait a year to get is going to be, it's useless. It's don't invest in a tech stock because of a dividend. Don't invest in any stock because of a dividend unless you have a stock that you're willing to hold because it's in a longer term uptrend and it's going to pay you while you also get appreciation. You don't want to get a 1% dividend and see your stock fall apart. And the trend in Cisco is guilty till proven innocent. It's below every moving average. It's in a downtrend, and it's just, it's a piece of garbage technology stock right now. Not, maybe there's good stuff happening at the company. Who knows? But as far as the stock goes, it still looks quite vulnerable. Google trying to find some support at its 200-day moving average in here, and you can see this has been a bigger level. I wouldn't be surprised to see maybe Google bounces a little bit, but the best days are behind it for a little while, it would appear. Goldman Sachs trying to find support at its 200-day moving average. So, some of these 200-day moving averages, we're going to get bounces from and that sort of thing, but it does not change these trends. When we have a declining 10, 20, 50-day moving average, they're not going to be able to move higher quickly and to turn that, ship around, as they say. Some of the stocks that do look decent would include, EBIX. Here's one that potentially could continue to move higher. It's got a nice looking weekly chart on the daily time frame. I think it'd have to clear probably about $28.70, and that's this little resistance in here. But clearing resistance doesn't make it all clear. You have to again consider your stop. So if you're going to buy a stock like this on strength, think about your risk, because there's still a lot of risk in this market. I'd say worst case stop maybe about $1 in EBIX if you're going to get involved in that. Goodyear Tire, which to me I wouldn't even buy this stock because it's Goodyear Tire. It's just a boring old stock, but it's got a decent looking chart. Sprint looks decent, but had a little bit of it's having trouble with this $5 level. But if you look at the weekly time frame, it's got some potential to run up through this level in here. It's had big volume on the upside, and is showing some resilience in this market. TTI is Tetra Technologies. It's got a good looking weekly chart here. You can see it's broken. It had broken this resistance, pulled back on some lighter volume, and now it's trying to kind of stabilize here. You go down to a 10-minute time frame and take a look. It's it's above that 5-day. Let's say 10-minute time frame, 5-day moving average, and it's found a little bit of resistance here. So it rallied up to that 1420 level. Now I think early next week, if it breaks back through that 1420, then you could be setting up for a test of 15 plus. Worst case stop would probably be about 1370. MGI, this is MoneyGram, and it trades pretty decent volume, about 800,000 shares a day. Broke some resistance. The weekly chart in MGI looks like it's got some room to run in here. What's going on? Okay, so there's not a lot to be excited about, though, especially when you see some of the bigger names like F5 that break those 200-day moving averages. I'm sure a lot of people were thinking, well, hey, the 200-day moving average is support. It's been holding the support. It got that bounce that day. Well, that 200-day moving average failed miserably today, and here it is continuing lower. So, some of these high-flying tech names are starting to undergo much deeper corrections. We've got VMware, which has broken its 200-day moving average this week as well, and still looking vulnerable, maybe down towards $70 a share. And it's not just the technology stocks. Didn't mean to get anyone dizzy there. Stocks like Walmart, WMT, has been trapped under its 200-day moving average and acts terrible. Velasys Communication is kind of toying around with these levels of prior support from last year, and on a weekly time frame looks quite vulnerable for further downside. And obviously, if you're going to short these things, you want to do it when they start breaking down, not on the gap up, but once they break below support and break volume weighted moving average, volume weighted average price and that sort of thing for the day. Las Vegas Sands, LVS, kind of having trouble with its 200-day moving average as well. So there's still quite a divergent market, but the fact is most stocks look sick. Most stocks do not look healthy, and even the ones that do, they're very difficult to trust, like the ones that I just pointed out. So we're in a treacherous environment. We continue to be, and we always want to manage risk and treat the market with caution and the respect that it deserves, because you can lose money regardless of what kind of environment you're in. If you're not in the right vehicle and if you're not managing risk, there's the opportunity to lose a lot of money quickly. And anyways, that's it. So let's take a look at. Thank you, Fibline, Joey, Sunrise, Snoopy. Let's take another look at your stock. I bet you it looks a lot worse than it did before, AGU, because everything looks worse than it did before. And what I was saying, I believe in AGU was that it looks decent. It's one of these stocks that on the weekly chart now, though, however, look at how the story has changed a little bit here. We do have a lower high and we do have a lower low. Now, that doesn't mean it's going to completely fall apart, but in an environment like we're in, I think you have to err to the side of caution. So we gapped down on, what would that be, Tuesday, and we've rallied up a bit. I would be very cautious in this area near that 20 and 50-day moving average. The 20-day moving average is dropping down through the 50-day moving average. And this area, I think, is likely to be, it looks close to stalling out. I don't know what your price is, or if you're upside down in the stock, or if you're managing profits. But here's a stock that looks kind of like the markets do. If it can continue to rally up, where does it have the potential to go to, though? And it's tough to make a case that it's going to be able to make it past that 50-day moving average. So I would say you want to be very cautious with this thing. And the number one job in here is, I'd say, manage risk. If it gets back below 88.5, I would begin to become pretty concerned about it, just because the overall market has changed a lot as well. Let's take a look at H&R Block for Johnny Utah. And let's see, Johnny, let's take a look at this. Was that Keanu Reeves' name in that movie, Point Break? Johnny Utah? I think it was. Anyways, H&R Block is, this is a bigger prior level of support. That did act as resistance before. It's acting as resistance, it seems now. We've had a rally recently from 13 to 16, maybe in anticipation of tax time. I don't know if there's a seasonal trade here. It doesn't appear to be very consistent if it is a seasonal type trade. But I would say that because it's at this prior level of important support, which has been holding as resistance a little bit, I would play a very strong defense in it. The daily chart, you look at the daily chart, it looks decent. It's got a nice uptrend. I would think breaking below this recent 15.5 or so, though, it might be the catalyst to get this thing for a little bit deeper correction in shares of H&R Block. So anyway, I guess that's going to do it here. Thanks for tuning in, everybody. It's been a long week. Hopefully next week we can see this market stabilize a little bit and things become a little bit easier. But until then, just have a good weekend, and I will talk to you on Wednesday. Thanks.